And I'd like to welcome you to this afternoon's session of The View from the Calpan. Our first speaker today is Stino Scaletta. He's a partner of taxation services with Myers Norris & Penny, or MMP. And as a partner in the taxation services located in the Brandon office, Stino is responsible for providing professional service advice in areas of tax planning and deferral and in the interpretation of tax legislation for MMP clients located in Brandon, Virden, Neepawa, Killarney, Deloraine, Souris, and Dauphin. And then just a couple housekeeping points. If you are tracking your CEUs, there are sign-up sheets in the back, and I would just like to remind everyone again to turn off their phones or put them on vibrate. And if you do have any calls during the presentations, to please step outside of the auditorium and not speak at the back of the auditorium. Thank you very much, and please join me in welcoming Stino.
Thank you. Farmland and the taxman, a very relevant topic, especially regarding your succession planning or plans that you plan to do. What we're going to talk about is, does the land qualify, and qualify for what? That's the capital gain exemption and the ability to transition that land to the next generation. We're going to look at the importance of getting your land history intact, and then a whole bunch of questions we're going to interrogate. And the reason for that is to formulate our analysis to determine whether we have qualified farm property or not. We'll have a short pop quiz to see if you're paying attention. We'll look at a few traps that are set. Perhaps you're already caught in the traps, and maybe by reviewing the examples, you may avoid the traps in the future. The importance of transferring farm property to your children, we'll briefly look at that. And farm corporations holding land as another opportunity. And we'll wrap it up. Unfortunately, we won't have time for questions. The material here is beyond the 30 minutes, but I will be at the MMP booth up in the main concourse area, and I'll be welcome to answer any questions you may have. So qualify for what? Well, the first one being the capital gain exemption. The Income Tax Act has two sets of rules regarding qualified farm property. First one dealing with capital gain exemption. Each individual has $1 million of exemption that can be used against a disposition of what we call qualified farm property, of which farmland is one of those items. Unfortunately, with the capital gain exemption, if you don't use it, you lose it. You cannot transition remaining exemption to next generation. Therefore, your succession plan should somehow formulate using that exemption if it does fit the scenario you have. In Manitoba, the tax savings of using the capital gain exemption is around $252,000. If you do use your exemption, you need to be aware of what we call the hidden tax, and that being AMT, which stands for Alternative Minimum Tax, and if you're a pensioner, the clawback of your old age security. The other sets of rules that the Act provides is for intergenerational transfer of farm property to your children, and that allows you to move farm property to your child at cost or an amount between cost and fair market value. The definition states that a child includes grandchildren and children-in-laws. And the nice part about it is a child doesn't have to be farming to receive the farm property. And the ability to transition allows the parents to move the property during their lifetime or upon their passing a testamentary transfer. So in order to determine if the land qualifies, the starting point is the history of the land. We must get the history of the land quarter by quarter. These are the couple of questions that we would be asking about your land. When was it first purchased by a member of the family, and how much did they pay for the land? When did it change hands, and under what circumstances? Was it inherited, meaning that it probably went at cost, or did the next generation pay fair value for the land? Who in the family has owned the land prior to you? That's an important question. In what year did you take ownership of the land? Who inside or outside of the family was actively farming the land? What are the total years farmed by family members compared to years not being farmed, for example, renting the land? And those people who were farming the land, did they have off-farming income? And if so, how much was that income? So it's very important that we get answers to these questions that help us do our analysis on whether we have qualified farm property or not. The first part of the interrogation is qualifying person ownership to see if we have the right people owning the land. The ownership chain is important because you look at the current owner of the land and you work backwards to see who in the families own that land. And that will help us decide whether we have qualified farm property or not. The land must have been owned by what we call qualifying persons for a minimum of 24 months. That's one of the tests they have in the Income Tax Act. Qualifying persons for the land include the landowner, the spouse, common law partner, the landowner's parents, or the landowner's children. Parents in the definition include grandparents, and children in the definition include grandchildren and children-in-law. Specifically not included in this list of qualifying persons is siblings, aunts, uncles, nieces, nephews, and cousins. If any of those own land, it could mess up the qualification for qualified farm property. If the ownership change is broken by one of these non-qualifying persons, all history that was generated falls off the table for that person. Where am I here? So here's a visual on how the qualifying person works. And it's based on the starting point being the current owner. So we have grandpa, they have 2 kids, they have 5 grandkids and 2 great-grandkids, one being the dog. So if this person here is the current owner of the land, the qualifying persons for this person would include grandma and grandpa, her parents, her spouse, and her child. If mother is the current owner of the land, the qualifying persons for mother would include her parents, her spouse, and her children and grandchildren. Now, if grandmother is the current owner of the land, the qualifying persons to her, I can't see it, would include everybody except for the dog. So the higher up you go, the more leverage we have regarding the land. Now part 2, the first part was the ownership qualification or users. Now it's the people actually using the land as part 2 of the interrogation. And we want to see that the right people were using the land to qualify it. Again, similar to the other tests, the qualifying persons include the landowner, the spouse, common law partner, the parents, the children, and children also includes grandchildren or children-in-law. Similar exclusion as before. Siblings are not eligible users of the property for the landowner. Nieces, aunts, uncles, cousins, similar. They're not eligible users of the land for the landowner. Depending on whether the land was last acquired by the current owner before June 18, 1987, that's when the legislation changed, the number of required years of qualifying use will differ. If pre-87, the test is 5 years of use by qualifying persons or using it in the year of disposition. And if the land is acquired by the current person post-87, it requires 2 years of use plus meeting the gross revenue test. Okay. So for the pre-87 rules, the land must have been used by the qualifying person principally, that's a key word, and we'll talk about that later, in farming activity in the year of the disposition or any 5 years before that time. For the post-87 rules, the land must have been used by a qualifying person principally in the business of farming in at least 2 years, and during that 2 years, the gross revenue from farming that land for that person has to exceed all other sources of income. What's interesting is for both sets of the usage rules, certain farming corporations or partnerships can qualify as eligible users for that land. So what is principally meaning? That means more than 50%. And that's measured in 2 ways: use of acres for farming, or the number of years farmed versus not farmed, i.e. being rented out. The principally use test for capital gain exemption is always combined with eligible owners and eligible users. Whereas for the intergenerational transfer rules, the principally use test is always referring to the eligible users. And then when CRA, or the Canada Revenue Agency, tries to apply the principally use test, they do it on the legal land description. And when you do your analysis, you could find out that certain quarters will qualify and certain quarters may not qualify. So when we compile all this information, we want to find out if we have enough years where the land in question was owned by the right people and was used principally in the business of farming in Canada by the right people. We could find out in our analysis that the land may qualify for the capital gain exemption, it may qualify for the intergenerational transfer, or it might qualify for both of those rules. If we determine that the land does not qualify for some reason, then we can have an opportunity to perhaps requalifying it, and that might mean going back to farming for a few more years to get the farming years higher than the non-farming years. It's a good idea to do an inventory or on your land, get a land history for that prior to doing any succession planning of trans land or selling the land. Because if you get the analysis wrong, it could be a $250,000 mistake plus interest and penalties. So let's have a few tests here. Scenario number 1. You acquire a quarter section of land in 2016 from your father by way of inheritance. It was purchased by your grandfather in 1960, and he farmed it until 2000 when he gifted it to your father. From 2000 to 2020, it has been rented to your uncle. It is now 2020, and your uncle wants to buy the land from you. Can you use your capital gain exemption? Okay. Here's the relevant facts. So the land was acquired in 2016, which means the post-87 rules apply to you. Ownership went from grandfather to father to you. Grandfather farmed it for 40 years. Your uncle farmed it for 20. Father never farmed it. You never farmed it. So I heard a lot of people saying no. Well, we'll see what the survey says. Oh. Yes, it does qualify. And the reason is that we have an unbroken chain from grandfather to father to you. And the fact that grandfather qualified it, that qualification passes down that chain. So anyone in that chain gets the benefit of someone qualifying for it. So in that case there, we do have a winner. Scenario number 2. You and your sister have purchased land together over the years and hold 10 quarters of farmland jointly. You each farm separately, and you report your farming activity on your tax return independently from each other. You have decided to sell off 2 quarters that you purchased back in 1985. Can you use your capital gain exemption? Oh, I hear no answers. So the relevant facts. Land was acquired in 85, which mean the pre-87 rules apply to you. which basically states that you had to farm the land for 5 years or in the year that you sell it. Well, the fact pattern shows that you farmed that land since you bought it, so you basically met that test, and you're also farming it in the year of disposition. But let's see what the survey says. No, you do not get your capital gain exemption. In order to qualify, the land must have been used principally by the owner or qualifying persons. Siblings are not considered qualifying persons to each other. So there's no way that the land that they own jointly could be used principally in farming because they only own 50%, and the other 50% is owned by a non-eligible person. So it's impossible for them to own more than, or to create that land to be qualified farm property because they don't meet the principally used test. However, if this land was gifted from father who did farm it, then they would be able to use their capital gain exemption because the qualification that father did transfers to them. But where they go out and buy the land together, their history is starting as non-eligible persons using that land. Scenario number 3. You acquire a half a section land in 2000 from your mother by way of inheritance. It was rented and farmed by your grandfather from 1920 until he actually bought the land in 1940. He continued to farm it until his death in 1972, and it was passed to your mother and your sister, each receiving a half section. From 1972 to today, it has been cash rented to various persons, none of whom are related to you. It is now 2020, and you would like to gift a quarter section to each of your 2 children. Can you transition that land using the intergenerational transfer rules? What are the relevant facts? Ownership went from grandfather to mother to you. Grandfather farmed the land for 52 years, and the land was cash rented for 48. Any takers? Okay, survey say it is yes. And the reason being is that the land had been principally used by the grandfather despite the fact that he rented the land for 20 years. He gets credit for renting that land because he was using that land and therefore he's an eligible user of that property for this determination. For the transition rules, provided the land had been used more than 50%, 52 years over 48, in a farming activity by a qualifying person, which is the grandfather, it can transition. The chain going from grandfather to mother to you is not relevant in this scenario because it's only relevant for the capital gain exemption rules and not for the transition rules. So that was a red herring that we threw into the example. The last question. Your father and uncle inherited land from your grandfather in 1985. Your father decided not to farm and has rented the land to his brother to date. The land was originally purchased by your grandfather in 1955 and farmed from that time until the gift made in 85 when he decides to retire. Can your father gift the land to you? So what are the relevant facts? The land was farmed by your father for 30 years. And then the land was then by your uncle for 35. Can we use the transition rules? And the answer is no. In order to qualify, the land must be used principally in the business of farming by the user or owner or qualifying persons. Siblings, again, are not qualifying persons to your dad. So dad and his brother are not qualifying persons. So the years of non-qualifying use, the rental, outweigh the qualifying use that the father or the grandfather did. So the land would not qualify for transition in this example, but would qualify for the capital gain exemption because grandfather qualified it for father who can transfer it to son. Now a few traps we'll go through. We have the spousal attribution trap, joint ownership, gift and sell transactions, and crop share farming. Well, we'll take spousal attribution for 500, Alex. So what this is about, or the trap occurs where you have one spouse that, let's say, bought their land before they got married. They get married, and upon the marriage, or a couple years later, they put the other spouse's name on title. And they do that for estate or succession planning. It used to be for probate, but the provincial government, I believe, is scrapping that. Because the spouse never paid anything for the land and just threw their name on it, the spousal rollover rules work, and they're automatic, which means that half the property goes over at cost to the other spouse. But because of that, the spousal attribution rules state that because the spouse never paid anything for the land, any income from that land is going to attribute back to the originating spouse. So if that land is sold, we only get one capital gain exemption. The only way out of the spousal attribution trap is the other spouse has to pay fair market value for whatever portion of land that they're buying. And actually has to pay for it. The originating spouse will have to report a gain. If it's eligible for the capital gain exemption, they can shelter it, but still, that's the only way to get around that. Another item to consider is if you are buying land, make sure it's in the name of both spouses, and then if it's going to be a mortgage, that both the names are on the mortgage to show that they are assuming the risks and rewards of owning that land. Again, you need to remember that the spousal attribution rules is all income from that land would attribute back to the originating spouse, including land rental. The second trap is joint ownership, which we covered in a couple of the scenarios. And again, this problem doesn't just apply to siblings. It applies if you own land with cousins, aunts, uncles, niece, or nephew. And the entire problem stems from the fact that there's no way that you can meet the principally used criteria in the Income Tax Act because you only own 50%. Workarounds for this problem could be that the landowners could then form a partnership or a corporation and have the corporation or partnership use the land, because a farm partnership and a family farm corporation are considered eligible users of the land for the individual. Another option would be land swapping. Trading of land would correct that problem. However, that's going to trigger a disposition. The relief from that is you could rely on the replacement property rules to defer the tax on that, provided that you meet that criteria for the replacement property rules. Whatever option you take, you're going to have to requalify that land for a 24-month period to get the qualified farm status back. The next potential trap, is gift and sell transaction. And a common scenario would be where mom and dad have already used their capital gain exemption and they want to sell the land to a long-time renter. The plan would be that mom and dad would gift the land to a child using the intergenerational transfer, moving it at cost. Then the child would sell the land to the renter and use their exemption to shelter the tax. However, if the sale that the son's making to the renter occurs within 36 months of the child receiving that land, that gain's going to go from the child right to the parents, and it goes back to the time when the parents made the gift, which means we could be subject to tax because they don't have exemption, plus interest and penalties. Another curveball to this transaction or plan occurs where the gift of the land to the child is in contemplation of selling it to the neighbor. So if there's evidence to the fact, doesn't have to be written evidence, but if there's evidence to the fact that, yeah, we're going to sell you the land, but it's going to go through my child, that's going to disqualify the child from using their capital gain exemption and reverts the gain back to mom and dad. So be careful of that. That's important. If you don't need your exemption and you know that you want to sell it eventually, that you move the land sooner than later to the child so that none of this curveball stuff could happen. Other problems could occur is that you move the land to the child and they don't follow through with the plan. They sell it to somebody else and they keep the money. When you make the gift of the land, they legally own that land. So you got to be aware that that's their land and they can do whatever they want with that. Another potential problem is if you gift the land to the child and they have matrimonial problems, you could expose that land to matrimonial distribution of property. One way to protect from that from happening is that when you get the transfer documents prepared, you want the lawyer to be instructed to state that you're transferring the land as a gift, as an inheritance. It's for the sole benefit of my child, and it's to be considered excluded property for matrimonial protection. And from talking to the lawyers in Manitoba, that works. In Saskatchewan, that does not work. Crop share arrangements is a good way to maintain your farmland status as qualified farm property, or if you go offside a bit, it could get you back onside. The criteria here is that in order for it to qualify, the owner would have to receive more than 50% to meet the principally used test that we talked about. The landowner also has to share in the expense and income of it as if they were farming. You can't just stamp crop share on the rental agreement and have that apply. And if the landowner is guaranteed amount coming back, then technically you don't have a crop share arrangement, but you have a cash rental arrangement. Transfers to children. Again, we talked about the importance of the capital gain exemption. Roughly it's $250,000 in savings depending on the province of residence. However, you can transition unlimited value of farm property to your child without any income tax consequences. Every individual, when they pass away, they have a deemed disposition of all their property at fair market value, the exception being qualified farm property. We can defer that or transfer that equity to the next generation. Consider, for example, land with an inherent gain of $4 million. You have mom and dad with $1 million each of exemption, but their estate still has exposure of $500,000. The ability to transition land and other farm assets to the next generation without tax is critical to the survival of the family farm, and sometimes we're finding that this is being overlooked. Another item is dealing with farm corporations holding land. There's an opportunity here as well, because shares of a family corporation qualify for the capital gain exemption, and they also qualify for the intergenerational transfer. As common as it is, there's a set of rules for this as well, and this one's a two-part test. The first being that for any 24-month period, more than 50% of the assets of the corporation have to be actively used in farming. And then the second test is the 90% test. So on the date of sale or transfer of shares, 90% of the fair value of the assets have to be actively used or principally used in the business of farming. The principally used test here generally means farming years exceeding rental years. One nice thing about farmland in the corporation, if it was on the outside, owned by the individual, like the parent, and then got moved to the corporation, we get to count those years that the land was on the outside. And the last point here is very important, and we've been running into this with some of our client analysis. Due to the 90% test, 1/4 of land that has been rented more than it's been farmed could disqualify the ability to move the whole value of the shares to the next generation or use your capital gain exemption. So you have one bad apple in the bundle, and it could disqualify everything for you. So the planning there would be to find a way to get the one bad apple, that 1/4 that's tainting everything, and moving it out of the corporation to preserve the total equity of the corporation. So in conclusion here, just as you could see, the qualified farm property rules are quite complex, and every situation that we discussed here is quite different. Thinking that your land qualifies when it doesn't will result in significant income tax liability to you. On the other side, thinking that your land does not qualify, but it does qualify, will end up having you leaving good tax dollars on the table. Just want to stress the importance of doing a land history of your land before you do any type of transaction, in particular selling the land or transitioning it. The sooner that you can plan and we find some curveballs, we could probably straighten out those curveballs to your advantage. And that's it. Am I out of time? Okay, they're saying I have time for questions. If there, yes. Okay, so the question is there any risk or fear that the government may remove the ability to use your capital gain exemption on your farmland? That comes up every time the budget comes out, that threat, but we haven't heard anything recently on that. Again, that they could pull the cord on that, but it was funny because when that rumor first started, the exemption was at $750, and then what did the government do? They bumped it up to $1 million. Yes?
The valuation day that used to be in the fix a few years ago, is it still a problem?
Sorry?
The valuation day, that B day that they talked about.
Okay.
1971 or something?
Yep. So what about it?
Well, you still have to know what that valuation was.
Okay. So the question is, so prior to 1970, there was no capital gain tax. And then when the government brought it in 71, you were able to set your costs based on the fair value of the assets at that time. And his question is, do you still need to know that? You do. The problem is you don't. A lot of people didn't sell land at that time. So what we have in our office is a big catalog of rural municipalities of land that was traded during that time. And what we do is we draw out a map and we see how close the quarter that we're dealing with is to a quarter that we have in that book, and then we'll use that V-Day value to be our cost base. Yeah. Oh.
Would you have a spare copy of your presentation?
I don't have a spare copy with me, but if you come to the booth, I might make arrangements for it.
Sorry to cut you off. Can I have a round of applause for Stino, please?